Welcome back to Smart Stock Sam, the channel where we cut through the noise and find the real story hiding inside the numbers. I'm Sam, and if you're new here, hit that subscribe button right now because this is the kind of analysis most finance channels simply won't do for you. What if I told you there's an artificial intelligence company literally building the decision-making backbone for the United States military, and Wall Street is practically giving it away? What if Goldman Sachs just quietly loaded up on this stock while everyone else was dumping it? And what if the very thing crushing the price right now is actually the setup for one of the most explosive short squeezes of the year? Today, we are breaking down BigBear.ai, ticker BBAI, a stock that has crashed nearly 28% since January 1st, even while locking in sole source intelligence contracts that competitors couldn't even bid on. We are going to dig through Q1 2026 earnings, tear apart the strategic transformation reshaping this company from the inside out, examine what the smart money is doing behind the scenes, and hand you a clean, actionable trade setup with hard numbers. Is BBAI an ultimate AI reversal play in the making, or is it a value trap dressed up in government contracts? By the end of this video, you will have everything you need to decide. Let's get into it. To understand where this stock is going, you first have to understand why it is having what I would call a full-on identity crisis. For years, BBAI operated as a services-heavy government contractor, consultants and analysts doing project work. That model works, but it has a ceiling. You grow only as fast as you hire people, and margins are capped because you're paying salaries. BigBear is now trying to be reborn as a platform-centric artificial intelligence company, one that sells software, not man-hours. And here's the thing about that kind of transformation. The market absolutely hates the in-between stage. When a company is halfway through a metamorphosis, it doesn't look like a butterfly yet. It just looks like a broken caterpillar. That is exactly what's driving the 26 to 28% year-to-date decline. But here is the part that should make your ears perk up. Constructive inflection points don't announce themselves. They show up quietly in the data, and then the stock rips before most people notice the turn. That is precisely what we are starting to see. The bad news looks priced in, and the structural improvements that actually matter for long-term valuation are just beginning to surface. Momentum is shifting, and high-value contract wins are starting to act as a floor for the price. The single engine driving this entire transformation is one acquisition: Ask Sage. Finalized in January of this year, Ask Sage is the primary catalyst reshaping how this company is fundamentally valued. Think about what the old BigBear looked like: services heavy, margins stuck around 21.3%. That is basically a consulting firm with an artificial intelligence label on the door. Now think about what a software platform looks like. You build it once. You deploy it 1,000 times. Each new customer doesn't require hiring another analyst or engineer. That is exactly the shift Ask Sage enables. BBAI is now pivoting toward annual recurring revenue, ARR, which is the metric technology investors love above almost anything else because it is predictable, sticky, and scales beautifully. And we are already seeing this show up in the real numbers. Gross margins have jumped toward 34%. Going from 21% to 34% is not a modest improvement. It is a fundamental change in the company's DNA, and it tells you the business model itself is transforming, not just the marketing language. So did any of this actually show up in the hard numbers for Q1 2026? Here is where it gets really interesting, because we got a classic beat-and-miss quarter. First, the good news. Revenue came in at $34.4 million, which actually beat consensus estimates. Yes, it is a slight 1% decline year over year, but the market was bracing for something worse, and that matters. The real headline, the number that caught many bears completely off guard, was that 34% gross margin. Now the miss. Earnings per share came in at a loss of 12 cents against an expected loss of 8 cents. The net loss narrowed slightly to $56.8 million, but for investors demanding a clear path to near-term profitability, this was a difficult result to absorb. What you got was a revenue beat on the top line, a margin beat in the middle, and an earnings miss on the bottom line. That split creates maximum uncertainty, and maximum uncertainty in a heavily shorted stock is exactly the environment that sets up explosive price moves in either direction. Now, let's talk about how they pulled off that margin expansion, because a 1,278 basis point improvement in a single quarter does not happen by accident. We are talking about a 12.7% surge in profitability per dollar of revenue, and it is almost entirely the Ask Sage effect. $25 million in annual recurring revenue added to the books, already deployed to over 100,000 users across 16,000 government teams. When your software is already embedded inside the Department of Defense and intelligence agencies, you do not have to spend heavily on lengthy sales cycles to keep that revenue coming. You just focus on expanding what is already working. That is the hidden growth story this quarter, the one the headline EPS misburied completely. The bears are pointing at the bottom line, but the sophisticated investors are reading the gross margin line and asking whether they just watched a company quietly turn a corner. But here is the honest reality check, and I am not going to sugarcoat this because that is not what Smart Stock Sam is about. Those 34% margins are genuinely impressive, but BBAI still has a serious operating leverage problem that you need to understand before sizing any position. Gross profit in Q1 was $11.7 million. Put that next to the SG&A expenses, selling, general, and administrative costs, which came in at $29.2 million. The company is still spending more than twice what it earns in gross profit just to keep the lights on. The entire investment thesis here hinges on scaling. BigBear needs to convert that massive backlog into GAAP revenue fast enough so that high-margin software income eventually overtakes those fixed overhead costs. Until that crossover happens, this is a speculative play. It is not a buy-and-forget position. Which brings us to the single most important number on BigBear's books right now, the backlog. Total backlog grew 14% sequentially to $281.9 million. That is extraordinary revenue visibility for the next 24 months. This company is not scrambling every day to find new work. The work is already signed and waiting to be converted into revenue. The crown jewel of this quarter was a $53 million sole source classified award from a United States intelligence customer. Think about what sole source actually means in government contracting. The government did not put out a request for proposals. They did not ask competitors to submit bids. They went straight to BigBear and said, "You are the only company we trust to do this." That is not a routine contract award. That is an endorsement of unique capabilities at the highest levels of the national security apparatus, and it creates a revenue baseline that makes BBAI significantly less dependent on unpredictable competitive bid wins. To make sure that backlog actually converts into cash, BigBear has been deliberately upgrading its executive suite. They brought in Joanne Bjornson as Chief Human Resources Officer and Alex Thompson to lead corporate affairs. But the hire that really caught my eye is Troy Miller, former acting commissioner of United States Customs and Border Protection. Bringing someone with that level of DHS experience onto your team is not about adding a fancy title to the website. It is about having someone inside the executive suite who knows exactly how the Department of Homeland Security allocates its budget, who the key decision makers are, and how to navigate the procurement process for massive government contracts. When you hire a former agency commissioner, you are signaling to every contracting officer in Washington that BigBear is a serious, trusted partner at the absolute highest levels of government. Combined with Ask Sage's existing penetration across 16,000 government teams, this leadership addition is designed specifically to close nine-figure deals. Now let's talk about the smart money, because this is where things get genuinely provocative. Institutional ownership in BBAI is still relatively low at 7.55% of shares outstanding, but the rate of change is what should grab your complete attention. Vanguard increased its position by 18.4% and now holds over 32 million shares. UBS grew its stake by 145%. And then there is Goldman Sachs, one of the most sophisticated trading desks on the planet, which increased its position by 569% in a single quarter. Let me say that again, 569%. While retail investors were staring at a 28% year-to-date loss and panicking, Goldman Sachs was quietly buying the dip at scale. So ask yourself, what is it that these institutions see that the average investor scrolling through their brokerage app is completely missing? But here is the other side of that coin, and intellectual honesty demands I give it to you straight. While the institutions are accumulating, the insiders, the people who actually work at Big Bear and sit on its board, are doing the exact opposite. Over the last 12 months, we have seen 18 insider sales and exactly 0 insider purchases. Most recently, Director Dorothy Hayes sold 15,000 shares at an average price of $4.11. Insiders sell for personal reasons all the time: taxes, diversification, estate planning. That is completely normal. But when not a single board member is stepping up to buy shares at what they should recognize as a significant discount, it sends a message. The insiders likely see that the path to GAAP profitability is still several quarters away. This is a red flag that should temper your excitement, and it is a big reason why range-bound swing trading, rather than a long-term buy and hold, is the smarter strategy here right now. From a pure technical standpoint, the setup for a violent short-term move is absolutely there, and the fuel for that potential explosion? Short interest. Right now, 29.62% of the float is sold short, 140 million shares that eventually must be bought back. With 3.43 days to cover, if Big Bear announces even one more significant contract win, these shorts could be forced to cover all at once in a chaotic pileup. Could we see a scenario where every short seller in this name gets squeezed out simultaneously on a single morning? The probability is low, but the structural setup is a coiled spring, and a coiled spring only needs one trigger to release everything at once. The options market is adding one more fascinating layer to this picture. Price anchoring between $4 and $4.50 for the May 15th expiration is where max pain sits, and stocks have a well-documented tendency to drift toward that level heading into expiration. But here is the really interesting signal. A bearish whale sweep of 1,400 call options at a $10 strike expiring in January 2027 was recently detected. Sophisticated options players are betting against a moonshot scenario in the next 18 months. Double digits are not the base case. What this all points to is a range-bound trading environment in the near term, not a meme stock vertical launch, but a series of structured, tradable swings with defined parameters. Technically, a bullish base is forming beneath what is still a long-term bearish trend. The stock is now trading above its 20-day and 50-day moving averages, which is constructive for near-term momentum. The MACD is showing that downward pressure is easing. The RSI sits at a neutral 52, not overbought, not oversold, exactly the sweet spot for entering a swing trade with room to run. However, the 200-day simple moving average at $5.49 remains significant overhead resistance. Until we clear that level with volume and hold it, we cannot declare a structural trend reversal. Here is your actionable playbook. Your ideal entry zone is between $4.05 and $4.15, right near that 50-day moving average support. Your first target is $4.50. Clear that with conviction, and you are looking at a run toward the analyst consensus range of $5.33 to $5.50. Representing approximately 30% upside from entry. For the longer-term optimistic scenario, $8.25 is on the table if federal AI spending tailwinds continue to accelerate. On the downside, $4 is your absolute line in the sand. That is where heavy put-open interest sits and where you cut the position. If we break $4 with sustained selling pressure, the next major psychological support level is $3.50. Respect those levels and let them govern your risk management completely. Before my final verdict, I need to address something important. Everything discussed in this video is strictly for educational and informational purposes only. I am not a licensed financial advisor, and absolutely nothing here constitutes personalized investment advice. Investing in individual stocks, particularly small-cap speculative names like BBAI, involves significant risk, including the very real possibility of losing your entire investment. Always conduct your own thorough research, consult with a qualified financial professional before making any investment decisions, and never invest money you cannot afford to lose entirely. The market can remain irrational far longer than any of us can remain solvent. Please trade responsibly. The final verdict: BigBear.ai is a classic high-risk, high-reward story stock sitting at a genuine crossroads. On the positive side, a fortified balance sheet with $431.5 million in cash eliminates near-term bankruptcy concerns. Ask Sage is already generating $25 million in ARR with 100,000 active users, and the $281.9 million backlog provides real revenue visibility for the road ahead. On the risk side, 18 insider sales with 0 purchases, a net loss still running at $56.8 million per quarter, and an operating leverage gap requiring aggressive scaling to close. This is a show-me story. The thesis is compelling, but execution has to prove it out quarter by quarter. Range-bound swing trading between the $4 support and the $5.50 resistance is the disciplined approach until Ask Sage revenue is visibly scaling fast enough to flip the operating income picture. The payoff for being right early, with 29% short interest and Goldman Sachs riding alongside you, could be exceptional. Stay disciplined, protect your downside, and watch that $4 level like a hawk. Now here's the question I want you to drop in the comments right now. Given the insider selling on one side and Goldman Sachs buying 569% more shares on the other, which side of that trade do you trust more, and what is your actual reasoning? I want to see your thinking. This community is one of the sharpest audiences in finance on YouTube, and your perspective genuinely adds to the conversation. If this breakdown gave you real, actionable value today, please give this video a like. It takes 2 seconds, and it tells the algorithm that this kind of deep dive analysis is worth spreading to more investors. If you are not subscribed yet, hit subscribe and ring that notification bell so you never miss a breakdown like this one. And if you truly want to support what we are building here at Smart Stocks Sam, YouTube has a super thanks feature right below this video. Even a small contribution goes a long way in keeping this level of independent research completely free for everyone watching. I am grateful for every single one of you who is part of this community. I will see you in the next update.